Welcome everybody to the next chapter in this course as we begin the accounting cycle. Now the accounting cycle will involve various steps in this process of analyzing various transactions. What we're going to cover in this next chapter involve everything here. It's a lot. We're going to identify steps in our measuring these external transactions, and then we're going to look at the impact of these external transactions we're going to measure on the accounting equation. Remember, assets equal liabilities plus stockholders' equity. And then we're going to assess whether the impact on these transactions result in a debit or credit to account balances. We're going to record these transactions in a journal using debits and credits. We're going to post those transactions then to a general ledger and come up with a trial balance. There's a lot to cover here, and I am really working to try to make sure that these lectures really give you the best source of understanding for this course. And if you have to go over these lectures 3, 4, 5 times, please do so you can absorb the information. Now, as far as functions of financial accounting, remember from the previous chapter we talked about that the two functions of financial accounting include measuring business activities of the company and communicating these measurements to external parties so that they can make decisions. And we communicate that information to parties by preparing financial statements. In this chapter, we are going to focus on procedures related to measuring business activities during an accounting period. In the next chapter, we're going to complete this accounting cycle that we're starting in this chapter by examining remaining procedures that occurred at the end of each period. Nearly every company accomplishes the accounting cycle using computerized accounting systems. So this chapter is going to show a manual system, so it helps you understand the basic model underlying most computerized programs. And if you can believe it, the first accounting job I had back in the early 80s when I got out of college, our system was totally done by hand. I look back now and just shake my head at the work we had. I did have, at the time was called Quattro. It was a spreadsheet formula that helped me, but pretty much we had a big general ledger and everything was balanced by hand, so it was quite the challenge. We're going to start by identifying certain steps in measuring external transactions. So as you see here, measuring external transactions is going to be a 6-step process. These steps are the key for the remaining chapters in this course. Make sure you understand these before you move on. If you don't get these, you'll be lost in the rest of this course. So it's really, really important that you understand these. Step 1 is we're going to use source documents to identify accounts affected by an external transaction. Source documents could be a bill, it could be a check, but it's some piece of paper that allows us to identify what's going on. Step 2 is analyzing the impact on the transaction through the accounting equation. Step 3 is assessing whether the transactions result in debits or credits to the balances. Step 4 is recording the transaction in a journal using these debits and credits. Then step 5 is posting the transactions to the general ledger, and then from there we're going to prepare a trial balance. Hang in there with me. So in measuring external transactions, we're going to start and review each of these steps. Step 1, gathering information about a transaction. Source documents like sales invoices, bills from suppliers, signed contracts, they provide information related to this external transaction. These source documents are used to determine the accounts that will be affected. Now, let's just think about a document such as a promissory note from a bank. That promissory note gives us the information we need to show when was a loan taken out, what is the amount of the loan, who was the loan with, what bank, what is the interest rate. You see how that source document allows us to gather information about a transaction. Step 2. The effect of the transaction on elements of the accounting equation has to be looked at. After each transaction, assets will always equal liabilities plus stockholders' equity. So no matter what, every time we record a transaction, when we're done, assets will always equal liabilities plus stockholders' equity. Step 3. In this basic accounting equation, assets equal liabilities plus stockholders' equity. You guys are going to get so sick of me talking about this. Accounts on the left side get increased with debits. Accounts on the right side are increased with credits. The opposite is true to decrease any of these accounts. After we identify the various accounts affected, we determine if it must be debited or if it's credited. Remember, debit just means left, credit just means right. Next, we record the transaction in a journal with debits left and credits right. Next, we post, which is the process of taking these debits and credit information from transactions, and we record them into a general ledger. So posting is the process of transferring this information from these transactions to the general ledger. Then, after that, we're going to prepare a trial balance, which is just a list of all the accounts and their balances on a specific date and time. And each balance is going to have a debit or a credit as their normal balance. So, after looking at these six steps that we're going to use to measure these external transactions, you're going to see some words that are going to be goofy for you, and you might not understand what they mean. Let's take a look at some of these definitions. And an account summarizes all transactions related to a particular item over a period of time. For example, all transactions affecting cash get summarized in the cash account. So when a company receives cash, the balance of that cash account increases. When a company pays cash, the balance of the cash account decreases. The chart of accounts is a listing of all the accounts that a company uses. So, for example, asset accounts, remember assets are resources. They include cash, supplies, equipment. Liability accounts can include accounts payable, salaries payable, utilities payable, taxes payable. Are you getting the hint on a lot of liability accounts? They end in payable. There are a couple liability accounts that don't have the word payable, but I'll guarantee you 99% of them do. Little hint for you there. And then stockholders' equity accounts include common stock and retained earnings. So the next step is looking and analyzing the impact these transactions are going to have on the accounting equation. Now, remember, the basic accounting equation is always going to be in balance, which means the left side, which are the assets, are going to always equal the right side, which is the liabilities and the stockholders' equity. Or the resources are going to always equal the claims to resources. Each transaction is going to have a dual effect. So if an economic event increases one side of the equation, then it also increases the other side of the equation by the same amount. Or if an economic event decreases one side of the equation, it's going to also decrease the other side of the equation by the same amount. Sometimes a transaction will not affect the total of either side, and we're going to kind of look at and see how that works. Hang in there with me. Next we're going to go to understanding the effects of transactions. So you have to ask yourself certain questions. What is one account in this equation that's affected by this transaction? And if I do this, is this account going to increase or is it going to decrease? And then we go, well, what's the second account that is going to be affected in the accounting equation? And is that account increasing or is that account decreasing? So after you note these effects, you're going to say, well, do assets still equal liabilities plus stockholders' equity? And guess what? They have to, every single time. At least two accounts are always going to be affected by every transaction or economic event that takes place. Now, while some economic events are going to affect more than two accounts, most events may only affect two accounts. So we're going to use an example of this Golf Academy. And the best way for me to help you understand how we do this is to just take some examples. So we're going to use this slide, and we've got 10 different transactions that we are going to utilize to help you understand for Eagle Golf Academy how this is going to play out. Now, this is the first month of Eagle Golf Academy's business operations in December, and we're going to take each one of these transactions and we are going to analyze, what are we doing here? How are we going to handle that? So each one of these, we're going to take our time, go through each one extensively. The first one, to begin operations, Eagle Golf Academy has to have cash. Cash is king, guys, always will be. To generate cash from external sources, Eagle is going to sell some common shares for $25,000. So remember, we're going to ask some questions. What is one account in the accounting equation that's going to be affected by this transaction? And does that account increase or does that account decrease? So what is one account, guys? Could it be cash? Because think about it. We are going to issue or sell shares of common stock. Why? Because we need cash. So one account that's going to be affected by this transaction is cash. Now, what's going to happen to cash? Is it going to increase or is it going to decrease? Well, it's increasing by $25,000. Remember, cash is a resource. This resource is owned by the company, which makes it an asset. Now, the company receives cash from investors, so cash is going to increase, and total assets ultimately increase by $25,000 because cash is an asset, right? Okay, hang in there with me, guys. So we know with this Eagle Golf, issuing common stock increased $25,000. The account, cash. Cash is a resource. A resource is an asset. It's going up. Cash is going up, which means assets are going up. Okay. Now, let's think of what's the second account that's going to be affected by this transaction. And does that account, is it going to increase or is it going to decrease? Okay, what's the account? What do you guys think? Common stock. Remember, we're issuing common stock. So in issuing it, we're receiving cash and we are developing or creating an investor. And so our equity is going to increase. So our common stock is our next account, and that common stock, which is a stockholder's equity account, is increasing. We're issuing common stock in exchange for $25,000 in cash. So it increases the amount of common stock owned by stockholders. So common stock and total stockholders' equity is also going to increase. So remember, cash increases and also the common stock or stock equity account is increasing. So, do assets equal liabilities plus stockholders' equity? Cash is increasing and it equals the stockholders' equity is increasing. Yes! We got it. Yes, assets increased by $25,000 and our stockholders' equity is increasing by $25,000. Remember, the accounting equation has to balance. The increase of $25,000 in assets equal the increase of stockholders' equity of $25,000. If one side of the equation increases, so does the other side. You can use this same series of questions to understand the effect on every single business transaction. So hang in there, guys. We're going to do this for 10 transactions in the month of December for this company. Now, let's look at a common mistake. Sometimes it's tempting to decrease cash as a way of recording an investor's initial investment. But remember, we are looking at it from the company's perspective. We're not looking at it from the investor's perspective. We are the company. We're thinking of transactions from the vantage point of the company. The company received cash from the stockholder. Therefore, the company is increasing cash. Okay? You got to remember which vantage point we're looking at these transactions. Okay. Now, in our next transaction, Eagle borrows $10,000 from a bank and signs a note for it. Consider these same questions. What is one account in the accounting equation that's going to be affected by the transaction? Does that account increase or does that account decrease? Okay? So, what's going to happen? Well, when we borrowed $10,000 from the bank, and we sign a note, cash is going to increase. Cash, again, is that resource owned by the company. That makes it an asset. So cash is going up, which means our assets are increasing. Now, guys, what's the second account that's being affected by this transaction? Borrowing money from a bank? Notes payable. We're borrowing money. It's a liability. Notes payable increase. We're borrowing money. It's going up. Notes payable represents the amount owed to a creditor. In this case, it's a bank. And as a result, it's making it a liability. Now, the company incurs debt when signing the note. So notes payable and the total liabilities increase in this example, right? So you see, when we borrowed money, our assets are now at $35,000 and our liabilities are at $10,000. Plus, with the first transaction, our stockholders' equity are at $25,000, so our assets are at $35,000, and our liabilities and stockholders' equity is also at $35,000. Do we balance? Yep, we balance. Let's go to another transaction. Once Eagle obtains financing by issuing common stock and then borrowing money from the bank, now the company can invest in some long-term assets necessary to operate the business. Buying equipment from a supplier for cash causes one asset to increase and another asset to decrease. So this transaction, purchasing equipment necessary for giving golf training for $24,000 cash. What happens here? What's an account that's being affected? Equipment. Equipment is going up $24,000. But what happens to cash? Cash is going down $24,000. So purchasing one asset, equipment, with another asset, cash, doesn't have any effect on the accounting equation, does it? Because one asset's going up, the other asset's going down. But we see we still are in balance. Our assets still equal our liabilities plus our owner's equity. So the equation still is in balance. Let's check your understanding here. What would be the effect on total assets if a company purchased land for $200,000 cash? What's going to happen with our assets? Remember, let's think about what are the accounts affected. If the company purchases land for cash, land is an account that's affected. Land goes up. Cash is an account that's affected. Cash goes down. But guess what? There would be zero effect on assets because one asset, land, would go up. The other asset, cash, would go down. Therefore, there would be zero effect on total assets. Remember, after each transaction, the accounting equation must always remain in balance. Assets must always equal liabilities plus stockholders' equity. Just always make sure you get in the habit of checking. Does my accounting equation equal? Are assets equal to liabilities plus stockholders' equity? Because they have to. They have to always be in balance. Let's look at another transaction. Eagle pays 1 year of rent in advance. So Eagle has to pay $500 a month rent, but it's going to go ahead. the company's going to go ahead and pay $6,000, which is 12 months worth of rent in advance. Now, purchasing rent in advance causes one asset to increase and another asset to decrease, because rent paid is for occupying space in the future. We don't want to record it as an expense immediately. Instead, we're going to record it as an asset representing the right to occupy the space in the future. It's a resource. We call the asset prepaid rent and report this amount initially as an asset, and then we will record it as an expense over the next 12 months as the time we've paid for it expires. And we're going to look at that in a future chapter. But for now, because we haven't used up this rent, it's a benefit for us still. It's a resource. We are showing prepaid rent as an asset, which increases, but the cash we use to pay for this prepaid rent decreases. So again, our transaction is in balance. Our assets went up and they went down, but it didn't affect our total assets. So our assets of 35 still equal our liabilities and our stockholders' equity of 35. Let's look at another one. We purchase supplies on account for $2,300. Now, we purchase supplies with the promise to pay cash in the future. On account means we haven't paid cash. We're going to. We refer to a liability of this type in which we are purchasing something on account as an accounts payable. The term payable means it's going to be paid in the future. Purchasing supplies with the promise to pay cash in the future causes an asset supplies to increase, but it also causes a liability, the accounts payable, to increase. Do you see how our assets, our total assets, increased $2,300? Now we're at $37,300. And the other side of the equation, the liability and the owner's equity, have also increased $2,300. So now the other side of the equation is also $37,300. So we can split the stockholders' equity into its two components. We can split it into common stock and retained earnings. Now, common stock represents investments by stockholders, while the retained earnings represent net income earned over the life of the company that's not yet been distributed to stockholders in the form of dividends. Both of these amounts represent stockholders' claims to the company's resources. Next, we can split retained earnings into some components here. We've got revenues, we've got expenses, and we also have dividends. Revenues get added to stockholders' equity. That's because revenues increase net income. And net income increases the stockholders' equity claims to the resources. So an increase in revenues has the effect of increasing stockholders' equity in the basic accounting equation. On the other hand, expenses reduce net income, and dividends represent a distribution of net income to stockholders. Therefore, an increase in expenses or dividends has the effect of decreasing stockholders' equity in this expanded version of the accounting equation. So, to summarize this, this expanded equation shows that revenues increase retained earnings, while expenses and dividends decrease retained earnings. The retained earnings account is a component of stockholders' equity. So you see the stockholders' equity is made up of our common stock and the retained earnings. The common stock are the shareholders, the stock. The retained earnings include all the income or revenues that have come in throughout the life of a company, minus all the expenses and all the dividends paid back to the shareholders. This expanded accounting equation shows that revenues always increase retained earnings, expenses always decrease retained earnings, and dividends always decrease retained earnings. Again, retained earnings will always be a component of stockholders' equity. Let's go on and let's now see how revenues affect the expanded accounting equation. So this transaction is where Eagle provides golf training to customers who pay cash at the time of service of $4,300. Now, providing training to customers for cash causes both assets and stockholders' equity to increase. Notice that an increase in service revenue increases stockholders' equity by increasing the retained earnings account by $4,300. Now, the accounting equation is still in balance because you see cash or the total assets increased $4,300 and the retained earnings increased $4,300. So our total assets now of $41,600 still equals our liabilities plus our stockholders' equity. You see our liabilities, we've got accounts payable of $2,300, notes payable of $10, we've got our common stock of $25, and now we have increase of retained earnings of $4,300. If you add all of these together, they are $41,600, which is what our assets are, $41,600. Let's take a look at the next one. Provide services on account. Customers receive golf training, but instead of giving cash, they promise to pay $2,000 cash at some time in the future. The fact that some customers don't pay cash at the time of the service doesn't stop Eagle from recording the revenue. Since Eagle performed the service, they have a right to receive the cash from the customer. This amount that is due to the company is something of value the company owns and therefore is an asset. When a customer does not immediately pay for services with cash, it can be said that services are performed on account and that we record an account receivable. Providing services to the customers on account causes both an asset to increase by $2,000 and it also causes our stockholders' equity section, the retained earnings, to increase by $2,000. So as you see here, our assets still equal our liabilities plus our stockholders' equity section. Now, companies sometimes receive cash in advance from customers. Eagle receives $600 from customers for golf training that's going to be provided sometime in the future later. In this case, the company cannot report revenue from training because it hasn't yet provided the training. Instead, The advance payment that the customer gave creates an obligation for the company to perform these services in the future. And this future obligation is a liability or a debt that's commonly called deferred or unearned revenue. Receiving cash in advance causes both the assets to increase and the liability to increase. Now remember, I told you that most every liability is going to have a payable after it. But this is one example when the liability does not have the word payable at the end of it. It has the word deferred revenue or unearned revenue, but it's still a liability because we owe that customer training. As you see here, our assets are still in balance with our liabilities and our stockholders' equity.